You know, we all want to invest in the future. I mean, big, world-changing ideas like artificial intelligence, clean energy, robotics. They feel like absolute sure bets, right? But what if I told you that trying to invest directly in these incredible themes is actually one of the hardest ways to make money? Well, today we're diving straight into the great paradox of thematic investing, why getting the future right so often leads to getting the investment totally wrong.
Okay, let's just jump right in with a number that should really make you pause. 77%. In 2024, that's how many thematic ETFs failed to be a simple S&P 500 index fund. Think about that. They were selling you the dream of the future, but they couldn't even beat the present.
And it gets even crazier. For the first time in a decade, these funds actually saw investors pull their money out. A net $7 billion gone. So what on earth is going on here? We've got these revolutionary ideas literally changing our world, yet the funds designed to capture all that excitement are bleeding cash and underperforming. That's the puzzle we're going to solve right now.
So here's our game plan. First, we'll nail down what this paradox is all about. Then, we'll look at the powerful mega themes that have everyone so captivated. After that, we're going to uncover the hidden performance traps, see how the pros play this game completely differently, and finally, build a disciplined approach that you can actually use.
All right, Section 1, the thematic investing paradox. This is really the core of it all. It's a wildly popular idea, but for most everyday investors, it's been surprisingly, well, unprofitable. So, what makes this so different? Well, traditional investing carves up the world into neat little boxes, like the technology sector or US stocks versus international. Thematic investing just throws that whole rulebook out the window. Instead, it organizes everything around a big story, a huge structural shift like AI that cuts right across all those old boundaries.
And wow, this chart just says it all, doesn't it? I mean, look at that growth, a nearly 10-fold explosion in assets over the last decade in the US alone. People love these stories. The appetite for them is absolutely undeniable. The problem is that huge disconnect between all that excitement and the actual returns.
Now let's talk about the stories themselves in Section 2, today's dominant megathemes. And let's be really clear, these narratives are powerful for a reason. They are very, very real.
First up, of course, is artificial intelligence. This has gone way beyond just the market trend. It's a fundamental rewiring of the entire global economy. The investment story itself is now shifting from the infrastructure guys, the chip makers, to the software companies that are finally figuring out how to actually make money from their AI models.
Next up, geopolitical fragmentation. This is basically the great untangling of global supply chains. We're seeing this massive trend of bringing manufacturing back home and a huge wave of investment into national infrastructure and defense as countries start to prioritize security over just finding the cheapest place to build something.
And you can't talk about themes without talking about the energy transition. The long-term shift to renewables, that's an absolute certainty. But, as we saw in 2024, the path for investors is just incredibly bumpy. Clean energy funds were actually leading the outflows even while real-world use of solar and wind was speeding up. This is a perfect example of the paradox.
Which brings us right to Section 3, the hidden performance traps. Okay, this is where we get to the real heart of the issue, the specific reasons why getting the big idea right so often goes so wrong for your portfolio.
This is a predictable and pretty painful cycle that traps so many investors. It all starts when a really compelling story emerges. Then, step 2, as the hype builds, valuations get stretched way beyond reality. Step 3, right at the peak of all that excitement, Wall Street launches a bunch of new products to meet the demand. And finally, step 4, a painful correction follows, catching all the investors who showed up late to the party.
And look, this is nothing new. This quote is a great reminder of the dot-com bubble. The internet was 100% a valid, world-changing theme, no question. But the market got so far ahead of itself that it led to a historic crash. The story was right, the timing was just dead wrong.
So let's break these traps down. First, there's concentration risk. You think you're diversified because you bought 5 different future of tech funds, but then you look under the hood and discover they all just own a ton of NVIDIA. Second, that valuation and narrative trap we just talked about. Third, fund closures. A lot of these funds don't even survive long enough to see the theme play out. And fourth, the constant slow drain of high fees on your performance.
And this number just brilliantly illustrates that survivorship problem. 68%. Think about that. Almost 7 out of every 10 European thematic funds that existed 15 years ago are just gone today. Shut down.
Your chances of picking a fund that would even survive, let alone do well, were incredibly slim.
So if the deck is kind of stacked against the average investor, how in the world do the pros do it? Well, that brings us to Section 4, how the professionals play. And let me tell you, they use a completely different playbook.
Now, this table is awesome because it lays out the contrast so clearly. The retail approach is often static. You buy a story and you just hold on for dear life. It's driven by the narrative. The institutional approach, it's dynamic and it's data-driven. They rotate between themes, they actively manage risk, and this is crucial, they operate in both public and private markets.
So what is this dynamic theme rotation anyway? It sounds fancy, but it's really an active strategy to avoid getting trapped. Instead of just holding one theme forever, it means you're systematically shifting your money towards the themes with positive signals, strong momentum or reasonable valuations, and shifting it away from themes that have just become too hyped and overcrowded. And here's the other massive advantage. The pros get in early. They do this by investing in private markets, which gives them access to game-changing companies like SpaceX and OpenAI. By the time these companies finally go public with an IPO, a huge chunk of their explosive growth has already happened, leaving public investors with a much more mature and, frankly, expensive stock.
All right, Section 5. Let's take all these lessons from the pros and translate them into a smart, actionable framework for you. This is all about building a disciplined approach. This might be the single most important slide for your own portfolio. Thematic investments should not be the core of your strategy. Think of them as a satellite position, a small, maybe speculative slice, say 5 to 10%, that orbits a stable, diversified core. This setup lets you manage your risk while still giving you a shot at capturing some of that thematic upside.
And before you ever pull the trigger on a thematic fund, please run it through this checklist. First, is the theme a real multi-year shift, or is it just a passing fad? Second, how does the fund actually pick its stocks? Third, check for that holdings overlap. Are you just buying more of the same big stocks you already own? Fourth, can you honestly stomach the volatility? And finally, do the high fees actually justify what they're doing?
But at the end of the day, the biggest challenge isn't financial, it's behavioral. This is where most investors stumble. You absolutely must have the emotional fortitude for multi-year periods of underperformance and the discipline to avoid chasing whatever was hot last year. That is the real secret to success here.
So we end with this question. The mega forces like AI, they are absolutely real. The investment opportunity is genuine. The challenge isn't knowing what the future looks like. It's figuring out how to profit from it. So you have to ask yourself, are you building a resilient investment strategy, or are you just buying a really, really good story?